Bangkok, 1997. You're 33 years old, managing a mid-rise property development on the edge of the city's construction boom. Your salary is paid in baht. Your project loan, $120,000, is not. For years, the exchange rate has hovered around 25 baht to the dollar, steady enough that no one bothers to hedge. The peg feels permanent, predictable, safe. In fixed exchange regimes, stability doesn't remove risk. It concentrates it, and history suggests that when pegs fail, they tend to unwind through the same arithmetic. In early June, rumors start circulating that Thailand's foreign reserves are falling faster than reported. The central bank steps in, selling dollars aggressively to defend the 25 line. Each intervention is meant to calm markets, yet every dollar spent defending the peg reduces the buffer behind it, narrowing tomorrow's capacity to defend it again. The policy begins to resemble a tightening corridor rather than a shield. Traders whisper about offshore forward contracts. By the third week, interest rates jump. Liquidity tightens. The defense grows louder and thinner at the same time. Then, July 2nd arrives. The peg is abandoned. Within days, the rate slips past 30, then 35. By the end of the quarter, it trades above 40. Your $120,000 obligation, once equal to roughly 3 million baht, now approaches 4.8 million in local terms, nearly 2 extra years of salary erased by an exchange rate line moving across a screen. Construction invoices arrive in the same currency, but the numbers no longer fit the projections you built your project on. Budgets you finalized weeks earlier no longer balance. Monthly payments feel heavier without changing size. Your income hasn't changed. The debt has. No riots, no sirens, just arithmetic. This wasn't panic, it was exhaustion. In this episode, we break down the 4 structural stages that turn a fixed exchange rate into a reserve drain spiral, and why defending a currency can accelerate the very collapse it seeks to prevent. You'll see how pressure migrates through the system long before the headline admits it. A currency peg sounds simple. It is not a price. It is a promise. A standing commitment by a central bank to exchange domestic currency for another at a fixed rate, on demand. That promise rests on reserves, not confidence, not growth projections, reserves. When Thailand held the line at 25 baht per dollar, it wasn't defending a number on a screen. It was defending convertibility. Every time someone wanted dollars instead of baht, the central bank had to supply them. In calm periods, that obligation feels distant, almost theoretical. In stress, it becomes immediate, a daily test of capacity. A peg imports discipline from the anchor currency. You inherit its interest rate gravity. You surrender flexibility in exchange for credibility. As long as capital flows in, the structure appears steady. But stability under fixed exchange regimes is conditional. When flows reverse, the same mechanism that signaled strength tightens into constraint. Promises require reserves. Reserves require coverage. Coverage requires time. And once time is measured in days rather than years, the peg becomes a countdown disguised as stability. A peg does not fail because markets lose emotion. It fails when liabilities outgrow buffers. When short-term external obligations rise faster than usable reserves, the system shifts from confidence to calculation. The psychology changes quietly. What felt permanent becomes measurable. At that point, the question is no longer whether the rate looks stable. It is how long the balance sheet can keep answering demand. Stage 1. Capital inflow boom. Before the break, there was acceleration. In the early 1990s, Thailand was one of Asia's fastest-growing economies. Growth rates were strong. Construction cranes multiplied across Bangkok's skyline. Capital moved in with confidence. The peg at 25 baht per dollar reduced perceived currency risk, and that single line on the chart quietly reshaped incentives across the entire system. Foreign lenders saw stability. Domestic developers saw opportunity. Dollar funding was cheaper than baht funding. Short-term external debt expanded quietly because it looked efficient. Why borrow locally at higher rates when global liquidity was abundant and the exchange rate appeared fixed? The peg did more than anchor the currency. It anchored expectations. As long as the rate held, foreign capital kept flowing into property, equities, and finance companies. Balance sheets stretched outward. Projects were modeled on stable exchange assumptions. Revenues were projected in baht. Liabilities were signed in dollars. The mismatch did not feel dangerous because volatility appeared absent. Rising asset prices masked the growing currency exposure underneath. Stability invites leverage. Leverage invites exposure. Exposure hides in calm periods. On paper, growth justified expansion. In practice, the system was accumulating short-term external obligations faster than it was building defensive buffers. The fragility was not visible in GDP prints or skyline photos. It was embedded in duration and currency mismatch. No currency spike, no credit freeze, no public alarm. But the structure was quietly converting growth into dependency. When foreign capital inflow becomes the oxygen of expansion, the economy begins to rely on its continuation. The day inflows slow, refinancing replaces momentum, and refinancing depends on confidence in the peg. That dependence is quiet at first, then it becomes structural. Stage 2. External imbalance accumulation, approximately 280 words. Growth continued, but the composition began to change. Imports accelerated as domestic demand surged. Construction materials, machinery, consumer goods, much of it financed indirectly by foreign capital. The current account deficit widened year after year. On the surface, this looked like confidence. Investment today, productivity tomorrow. Headlines pointed to expansion. Balance sheets were quietly stretching. Underneath, it was arithmetic. A current account deficit means the country is spending more foreign currency than it earns. The gap must be financed. As long as capital inflows exceed that gap, the system feels balanced. But once stability depends on uninterrupted inflows, it is no longer strength. It is a condition that must be continuously renewed. Short-term external debt began rising faster than export growth. Finance companies rolled over dollar liabilities every few months. Developers refinanced projects assuming liquidity would remain available. Each rollover shortened the horizon. Funding that once felt annual began to feel quarterly. The peg held steady at 25, reinforcing the belief that currency risk was negligible. Deficits widen quietly. Debt shortens silently. Coverage ratios tighten invisibly. The mismatch was no longer just private. It was systemic. External liabilities were accumulating with shorter maturities, while reserves were finite and slower to grow. On paper, everything still cleared. In structure, duration was compressing, and compressing duration turns patience into vulnerability. When foreign lenders fund long-term domestic projects with short-term external credit, the system becomes dependent on renewal. If renewal slows, pressure shifts immediately to reserves. If reserves are drawn down to defend the peg, the margin for error narrows further. Nothing had broken yet. But the balance had shifted from expansion to maintenance, and maintenance requires a confidence to roll forward. Every quarter, every month, sometimes every week. The system was no longer just growing, it was refinancing itself. Stage 3, Reserve Defense Phase, approximately 330 words. By early 1997, the pressure was no longer theoretical. Capital inflows slowed. Some reversed. The same investors who had funded expansion began asking harder questions about reserves, rollover capacity, and forward commitments. The peg at 25 was no longer a background assumption. It was a line being tested. The central bank responded the only way a defending authority can. It supplied dollars. Spot intervention first. Direct sales into the market. Then forward contracts, commitments to deliver dollars later in order to stabilize the rate today. On the surface, the exchange rate barely moved. Stability appeared intact, but defense consumes the very resource that makes defense credible. Each dollar sold to protect the peg reduced the stockpile available for tomorrow. Each forward contract pulled future reserves into present obligations. The headline number of reserves still looked substantial, but usable buffers were thinning beneath it. What looked like stability from the outside was an active transfer of optionality from the future to the present. Defense buys time. Buying time spends reserves. Spending reserves shortens time. Interest rates rose as part of the defense. Liquidity tightened further. Domestic credit conditions hardened. Developers who had relied on continuous refinancing felt funding costs climb. Banks grew cautious. Projects slowed. If your income lived in baht, the exchange rate still appeared fixed. But the cost of money was rising around you. If you held government bonds, yields widened as risk perception shifted. If your business depended solely on domestic demand, higher rates squeezed margins. International revenue earners, however, were quietly gaining relative advantage as pressure built. The more aggressively the peg was defended, the more visible the constraint became. The market did not need to defeat the central bank in a single strike. It only needed to outlast it. Stage 4. Speculative break plus forced float. Approximately 280 words. By late June, the question was no longer whether pressure existed. It was how much duration remained. On July 2, 1997, the Bank of Thailand stopped defending the 25 line. The peg was abandoned. The currency was allowed to float. The adjustment was not explosive. It was sequential. First 30, then 35, then past 40. Each move recalibrated balance sheets in real time. Contracts signed under one exchange assumption were repriced under another. Dollar liabilities did not renegotiate themselves. They translated. Your $120,000 loan, once roughly 3 million baht, was now approaching 4.8 million. The structure of the obligation hadn't changed. The exchange rate had. The math alone altered your leverage ratio, your debt service burden, your project viability. A movement on a currency chart became a compression of equity. Developers faced rising default risk. Finance companies confronted currency mismatches they could no longer mask through rollover. Banks absorbed stress as collateral values weakened. The adjustment moved through layers of the system. Private balance sheets first, then institutional ones. This is how fixed exchange regimes tend to fail, not in chaos, but in conversion. A defended price becomes a floating one. A promise becomes a market clearing number. Once reserves are insufficient to meet redemption demand, price replaces policy. The break did not create the imbalance. It revealed it. And when the rate moved, the hidden fragility embedded during the boom surfaced all at once, not as emotion, but as recalculated obligation. The peg ended quietly. The arithmetic did not. The popular narrative that followed was simple. Speculators attacked, the currency collapsed, and Thailand fell victim to external pressure. It is a compelling story. It is also incomplete. Speculators did not create the imbalance. They tested it. If reserve coverage had comfortably exceeded short-term external obligations, aggressive positioning against the baht would have failed. Defending the peg would have required fewer reserves, not more. The attack would have exhausted itself, but the arithmetic had already shifted. When external liabilities grow faster than usable reserves, defense becomes fragile by structure, not by sentiment. Traders do not need to overpower a central bank. They need to measure its duration. Once markets sense that reserve burn exceeds replenishment, positioning becomes a calculation of time. This is the uncomfortable pattern across fixed exchange regimes. Attacks succeed where coverage is thin, and fail where buffers are deep. The pressure does not invent weakness. It exposes it. Defense can even accelerate recognition. The more aggressively reserves are deployed, the clearer the constraint becomes. Forward commitments signal strain. Rising rates confirm tension. What was once a rumor becomes observable. The shock is not that traders moved against the peg. The shock is that the peg required continuous proof of strength, and proof it consumes resources. Markets did not cause the clock to start. They noticed it was already running. Every peg contains a clock. It is rarely displayed, but it is always there. Embedded in the relationship between reserves, short-term external obligations, and the daily pace of intervention. As long as reserves comfortably exceed near-term liabilities, the clock feels distant. When coverage narrows, time begins to compress. In Thailand's case, The relevant question was no longer whether the exchange rate could be defended in theory. It was how long reserves could meet redemption demand while also covering forward commitments and rollover needs. Each day of intervention did not simply stabilize the market, it reduced tomorrow's flexibility. Duration was being converted into defense. Reserves decline incrementally. Obligations mature on schedule. The gap is measured in days. Once short-term external debt approaches or exceeds usable reserves, the peg shifts from anchor to timer. Confidence may still exist. Growth may still print. But arithmetic starts to dominate psychology. The clock does not announce expiration. It tightens quietly as buffers thin. And when duration falls below demand, the adjustment is no longer discretionary. It becomes mechanical. Shift to the present. The variables look different. The arithmetic does not. Across multiple economies today, debt to GDP ratios trend higher than they did a generation ago. Sovereign maturity profiles in some markets have shortened. Interest expense absorbs a growing share of government revenue. In several regions, reserve coverage relative to short-term external obligations is thinner than headline reserve figures suggest. On the surface, stability holds. Currencies trade within expected ranges. Growth prints. Bond markets clear. The system appears orderly, but order can coexist with compression. When refinancing cycles shorten, flexibility narrows. When interest burdens rise relative to revenue, policy space tightens. When reserves are deployed to smooth volatility, future optionality is exchanged for present calm. These are not predictions. They are structural conditions. Thailand in 1997 was not an anomaly of emerging market immaturity. It was a demonstration of how fixed commitments interact with mobile capital. The same mechanics apply whenever external liabilities must be continuously rolled and defended. Confidence can persist for years. Buffers can erode quietly. Duration can shrink without headlines. The question is not whether a peg, a policy framework, or a funding structure appears stable today. It is how much coverage exists relative to obligation, and how quickly that coverage is changing. When refinancing becomes constant, what determines who absorbs the adjustment first? A peg is not ideology. It is arithmetic wrapped in confidence. For years, 25 baht per dollar looked immovable. It felt like policy strength. But a fixed exchange rate is only as durable as the reserves standing behind it and the maturity structure pressing against it. When short-term external liabilities rise faster than usable buffers, defense becomes a question of duration. Duration is finite. Thailand did not collapse because sentiment turned negative overnight. It adjusted because coverage ratios narrowed below redemption demand. Once reserves could no longer credibly meet short-term obligations and forward commitments at scale, price replaced promise. 25 was not a lie. 40 was not hysteria. Both were numbers clearing different balance sheets. The break did not create the imbalance. It reconciled it, and that is the uncomfortable pattern across fixed regimes. Stability persists until arithmetic forces repricing. Not because policymakers lack intent. Not because markets are emotional, but because liabilities mature on schedule, reserves do not replenish instantly, and time cannot be printed. When buffers thin faster than obligations roll off, the system does not ask permission to adjust. It simply recalculates. If this breakdown sharpened how you see fixed exchange stability, comment coverage ratio.